A very good afternoon, everyone. Welcome back to the 8th of September weekly market review. We have finished the first week of September, typically the worst month of the year based on seasonality, but we came out the first week positive on a positive note, I would say. But before we go further, let me introduce Gerald. How are you, Gerald?
Hi Sunny, hi everyone who has joined us today. Yes, so we are now in September. It's also the start of the school holidays. So while you might be taking a break or bring your kids somewhere, the markets have actually been fairly active, especially with the US jobs data that came out last Friday. So I'll be sharing more about some of these updates in today's weekly market review.
Yes, thanks for reminding us that it's school holiday. It's a time that I can wake up slightly later because I don't have to send my kids to school. But then back to the market, we saw the non-farm payroll, the most important data the first week of the month. Not very positive, but then that more or less confirmed that more or less confirmed, I would say, that we will see a rate cut in this month rate decision. So I think I'll let Gerald take us through some of the details that happened last week.
Sure. Today's sharing is for informational purposes only and should not be taken to be financial advice. If you find the weekly market review helpful, do leave us a review on Google. And if you'd like to join SIAS as a member, you can scan this QR code or go to the website sias.org.sg/membership. And as a SIAS member, you can access various online resources as well as investor education programs. So in the past week, we saw a slight bounce in the US market. The S&P 500 gained by 0.3%, and this is led mainly by the tech stocks, with the Nasdaq up by 1.1%, especially with the bounce that we saw with Google's parent Alphabet, as well as Apple share price. Back home, the STI reached a new all-time high, 4,307 points, with a 0.9% gain in the past week. Okay, so the key data point that came out last week is the US jobs data. We see that it has been very weak in the month of August. And more importantly, we also see the June number being revised downwards, such that it is now a negative number. So that is actually the first time that we see a negative number in a few years, which has reinforced investor perception that the US labor market is showing signs of weakness. So what does that mean? It means that investors are now more hopeful of a potential rate cut by the US Federal Reserve. So this is the probability of Fed rate cuts, and now what we see is that close to 90% probability of 125 basis points rate cut. And in fact, investors are now also having a portion of them who expect that we will see a 50 basis points rate cut to 3.75 to 4%. So effectively, if you add both of them up, it means that investors are almost certain that we'll see a rate cut coming through in the Fed meeting on the 17th of September. This may be followed by another rate cut in October and another one in December. So what this means is that investors are increasingly expect that interest rates will trend lower in the coming months. So we see that being reflected in the US 10-year government bond yield. There has been a sharp decline in the 10-year government bond yield last Friday after the announcement of the jobs data, now at about 4.1%, having come down from about 4.3% just about 1 week ago. In Singapore, we also see this decline in the Singapore 10-year government bond yield, which now stands about 1.85%, having started the year at above 3%. Okay, so in terms of the top performers in the past week, we have Yangzijiang Shipbuilding after the announcement of sizable order wins. So that has helped to lift sentiment towards the shipbuilding stock. Okay, in terms of the worst performers, we see some profit taking in SGX City Developments after the very strong run up over the past few months. Okay, the name that I wanted to share more about today is Singtel. It is one of the names that is helping to drive the STI up to new highs. And as we can see here, Singtel has been a strong performer in the Singapore market, having started the year at about $3.20 per share, and now at $4.40. Okay, so the company actually held Investor Day last week, where they actually gave investors an update on how it is tracking versus its Singtel 28 target. So overall, we see that it is pretty much on track. If you were to look at the operating company's operating profit, we continue to see the growth there, driven by an improvement in the margins that is able to make within this segment. If you're to look at the progress towards the recycling, the company has continued to drive capital recycling, with 4 billion realized so far of their 9 billion target. And with that, they have already announced the 2 billion inaugural value realization share buyback. Overall, we see an improvement in the underlying net profit of Singtel. In FY25, it actually grew by about 11%, from 2.3 billion to 2.5 billion. And that momentum has continued in the first quarter of fiscal year 26. Okay, so this is how the company is now tracking in terms of the first quarter FY26 versus the FY26 targets. Overall, we see that the operating company operating profit continues to grow at about 10% year on year. They continue to deliver on the cost savings and continue to get fairly sizable dividends from their regional associates. So they believe that with this, they are on track to hitting their low double-digit return on invested capital target in the medium term. Okay, so one of the key drivers of the improvement in profit is also coming through from this few different areas that they have identified to be the core business, including Singtel and Optus, as well as the growth engines, including NCS and the data center business. So overall, that is helping to drive the improvement in operating profit across Singtel. So with the improvement in profit, they have actually raised the dividends in FY25, total dividend per share of 17 cents, including a value realization dividend of 4.7 cents. And that actually represents the fourth straight year of dividend growth, with the dividends having more than doubled from FY 2021. Okay, so all in, we see that they are confident about being able to deliver healthy growth in the dividend per share. The company's guidance is for the core dividend growth to be coming through from the higher underlying net profit after tax. They have also this value realization dividend from the recycling pipeline. And at the same time, with the unlocking of the capital, they have this 3-year program involving a value realization share buyback of up to 2 billion. Okay, at the same time, with the assets that have been identified to be divested, they believe that they have then a sizable capital war chest based on the cash balance of 4.3 billion, as well as the improving performance coming through from the regional associates that will help to drive dividend upside. Okay, so that effectively will translate to value for shareholders. So with the 9 billion midterm asset recycling target, first and foremost, we have the value realization dividend, we have the value realization share buyback, and more importantly, that still leaves some remaining capital to be able to fund the growth initiatives. Okay, so in summary, what the company has positioned itself to be would be that it is a company with stable performance that would drive resilient cash flows. The company has a healthy balance sheet. they have been committed towards growth in the dividends, coming through from the improvement in the underlying net profit as well as the value realization dividend. And the growth would potentially come through from multiple levers, including Optus and Singtel Singapore. It would include some of the growth businesses, including NCS and its data center business, as well as continued momentum in the regional associates. Okay, so in terms of what to look out for in the week ahead, given the upcoming expectations of the Fed rate cut, investors will want to get a final confirmation from the upcoming US inflation data that's coming up on the 10th of September. Okay, so with that, I'll hand over to Sunny, who will share the technical analysis.
Okay, thanks, Gerald, for that update on the markets and the coverage on Singtel shares. Dividend investors, I think, would be very interested in that given all the additional dividends that Singtel will be announcing. Let's look at the roundup of the major indices in Singapore and the US. Let us start with the STI Index. So last week, we sort of said that the index would likely trend sort of a trend around this range-bound region. So indeed, it was much of it was true, but we also have a very sort of a positive breakout above the double top formation that we see over here, but still kept at the upper bound of the Bollinger Band, now somewhere around the 4,321 points. We also have a new sort of an all-time high on the STI index as well, and that happened on Friday at 4,320. That is the new all-time high that we are looking at for the STI index. This Monday morning, early morning, we can still see that STI is still holding up above the 4,300 points. So I think the range-bound movement will likely follow inside the Bollinger Band area. The lower bound of the Bollinger Band now at 4,191, coinciding with the 50 days moving average at 4,194. So 4,002 will be a strong support level for the STI index with the 20 days moving average in green, 4,250 points being the pivot level to watch out for. Okay. So on the MACD indicator, we have turned positive last 2 or 3 trading sessions. That means that there's a slight uptrend momentum in the STI index, but I don't see that as kind of a breakout kind of a momentum because looking at the trajectory of the MACD, it is still rather horizontal, rather flat. So I think we will continue to trend along the upper bound of the Bollinger Band area, but unlikely going to have a massive breakout soon. Okay, the reason is because the RSI is also showing some signs that it will reach the overbought level, which is above the 70-point mark, now at 67. So once we reach that point, index will also be poised for a technical pullback, and that is the sort of the setup that I would like to prefer to see before riding on any of the technical trends. Okay, so on the STI index, let's look for the 4,200 as a strong support level to get back in, with the 4,250 as the pivot and the 4,300 and above as the target going towards the end of the year. Next, let us move to the US indices. So like Gerald mentioned earlier, the weekly performance of the US indices were rather positive. We saw a more than 1% jump in the Nasdaq Composite Index. So that is a good sign. We also flirted with a new all-time high for all 3 indices as well. The Dow Jones Index last Friday hit a high of 45,770 points. That's an all-time high. And that was also the day where the non-farm payroll was being announced. I remember I was watching the market, 8:30, the figure came out that US futures actually jumped. And even when the US market opened later, in the initial early trading, market also jumped to the all-time high, but after that closed lower. Okay, this is a sign that market is now more worried about the economic performance of US rather than inflation. So the Fed would have tilted away from imbalancing the risk, would have tilted towards managing the risk of the economy rather than the worries of inflation now. So the data that is going to come out, like what Gerald mentioned, this week we have the CPI data as well as the PPI data. those are the things to watch that we need to see that inflation is being kept in check so that it allows the Fed the room to go and cut rates or even cut rates more going into the end of the year. Okay, so the Dow Jones Index high is now at 45770. Okay, we are still much within the Bollinger Band range, which is the upper bound at 46,014 points, the lower bound at 44,147 points. But I think unlikely in the near term we will reach the lower bound of the Bollinger Band. We would likely see some bounce coming in at the 50 days moving average at 44,638 points now. Okay, looking at indicators, likely a range bound kind of reading on the MACD indicator. We turned negative last Friday because of that non-farm payroll result that caused the market to close lower. So we will likely be a range bound kind of formation going forward as we seek more clarity with more macroeconomic data as well as the rate decision that Powell will share, okay, in the middle of the month. Okay, the RSI is also quite neutral. A slight positive momentum at 57-point reading, 7 points above the 50-point neutral mark, but does not suggest any kind of big movement coming up soon. So I think the range bound movement for the Dow Jones Index will likely be the 50 days moving average at 44,638 points, with the high at the 46,000 level. That will be the key resistance to watch out for. Next, let us move to the S&P 500. Similarly, last Friday, early trading period in the S&P 500 index after the non-farm data came out, we hit a high of 6,532 points. So that is a new all-time high for the S&P 500. Okay, traditionally, like I said, September has always been a sort of a negative month, okay, based on seasonality. But given how the positive start we have in the first week of September, I think this year round we may not be that badly impacted. On average, we lost about slightly less than 1%, according to past 5 and 10 years data of the S&P 500 movement in the month of September. So we are up 0.6% last week on the S&P 500. So let's say if we have a flat month, okay, for the broad index, I think that is already a very good showing, and that could set us up for a year-end rally. Okay, so the range, looking at the next support level, definitely S&P 500 is now trending very strongly on the 20 days moving average, as you can see. Even though we touched that 20 days moving average last Friday, it also rebounded back up. It's now the closing is between the upper bound of the Bollinger Band at 6,521 with the 20 days moving average at 6,444, and then we ended at about 6,481. Lower bound of the Bollinger Band and the 50 days moving average finding some confluence, so that will give a lot of support if, let's say, index were to retrace to this level, and that could be an accumulation point that is around the 6,367 points or 6,350 points level for the S&P 500. S&P 500 has also been sort of having a negative reading for the past 2 weeks or so, the last 10 trading days. So, but that sort of that negative reading on the MACD indicator is not much of a concern because it's not looking drastically bad, but just trending along the line to see how the interest rate and inflation data performs in the coming weeks to look for the next trigger. Okay, RSI is now at the 58-point reading, 8 points, just 8 points above the 50-point neutral mark. So I would say it also suggests that the MACD is correct, that we will still be in a range bound formation with the support at 6,350 with the high side at the 6,532 points level. Okay. Next, let me move to the Nasdaq Composite Index. We also had a new all-time high, so that's why I said we started the first week of September. Rather positively, the all-time high for the Nasdaq now set at 21,878 points. We closed between the 20 days and the upper part of the Bollinger Band. So that is, we closed at 21,700 with the 20 days moving average at 21,510 points. Okay. So similarly, when we had the low on the 2nd of September, where it goes to a low of around the 21,000 level, it's supported by the lower bound of the Bollinger Band as well as the 50 days moving average. So let's say it trended down to this level again, which the Bollinger Bands now stand at 21,147 points, with the 50 days moving average at 21,066 points. The 21,000 level will be a very strong handle or support for the Nasdaq Composite Index. Okay. So the Nasdaq Composite Index, the MACD reading has been negative for past 2 weeks already. So I think that is more of a concern because of the macroeconomic concern that we are more worried now rather than inflation. So I think investors would need to be careful when trading the more volatile Nasdaq Composite Index and wait for a pullback towards the low bound of the Bollinger Band before considering any entry. Looking at the RSI, the reading is just 9 points above the 50-point neutral mark. So it's sort of a pretty in a neutral zone, I would say. And if you look at the longer term RSI, 14 days RSI period, which is the yellow line, is also trending down. So that is putting a lot of pressure on the Nasdaq Composite Index. And the only catalyst that we can see these high leverage stocks being pushed up another leg higher would be the confirmation of the rate cut that is coming in the middle of September. Failure to do so, I think the Nasdaq Composite will see a bigger retracement, and that means that we could likely see the 21,000 handle coming into play soon if we don't see a rate cut. But if we do see that, then definitely the 20 days moving average will be continued to be used as a support for the Nasdaq Composite Index to trend towards the last quarter of the year. Okay, so these are my takes on the indices this week. We have a very data heavy week this week. So what other things we need to look at, Gerald?
Yes, so really it is the inflation data that we'll be keeping a close lookout for. With the increasing expectations of the rate cut coming through, I think investors would just want a confirmation that inflation has eased and that it is not spiking up once again. Otherwise, it will be a cause of concern given that we are seeing the signs of weakness in the employment market at the same time.
Yes, so if let's say inflation were to be kept in control, then it will not put the Fed in a very tight spot as well to execute the rate cuts, and that would give more comfort to the market for us to stay nearer to the all-time high. So I think that's all the time that we have for today. We look forward to update you with all the key macro data next week. So do stay tuned to next week weekly market review. We will see you same time, same place every Monday on the CIA's weekly market review. Goodbye.